My name is Jon Henry. I'm a director and a product specialist in Baillie Gifford's clients department, and I work closely with the portfolio managers in looking after the Monks Investment Trust. So I'm going to run through the most appealing aspects of the trust and give you some reasons why you should consider Monks for investment via your ISA. I'm going to start first of all with what exactly the trust is all about. Fundamentally, Monks is our best ideas growth portfolio, which is managed by Baillie Gifford and the Global Alpha team specifically there. We invest in around 100 stocks from right around the world. We believe these are the very best growth stocks available to us. And by growth, we're talking about growth in revenues, earnings, and cash flows. We focus very much on long-term capital growth, and that is perfect, we think, for ISA savers with long-term time horizons. And fundamentally, we set out to be low cost. So the ongoing charges figure for Monks is 48 basis points, and that's been falling since the Global Alpha team has taken over management of Monks back in 2015. So who actually manages the trust itself? Now the slide here shows you the various layers of resource that we have. Now the key decision makers are at the top, and the points I would make here would be firstly that this is an experienced and senior team that look after the Monks Investment Trust. Spencer Adair, Malcolm McCall, and Charles Plowden are decision makers on the trust itself. So they decide what to buy and sell within the vehicle. Now I should say here that Charles is retiring at the end of next month, and Spencer and Malcolm will be remaining as the managers, so there continue to be significant experience within the management team of the Monks Investment Trust. Importantly, the layers and depth of resource continue too. So we're supported by dedicated analysts in blue there. So you can see there's 5 dedicated analysts, as well as a network of what we call scouts from right across Baillie Gifford's investment floor. So they're putting forward their very best ideas from the regions right around the world for potential inclusion within the trust itself. So effectively what we're doing is really harnessing the very best stock picking ideas from right across the investment floor at Baillie Gifford, and that gives us the belief that we can generate attractive returns for savers in the trust. So what is it about Monks's approach that is differentiated? Well, I think there's 3 key things. The first is that we believe, without exception, that it's companies that can sustainably grow the revenues, earnings, and cash flows over the very long term that will have the greatest chance of adding value, seeing their share prices rise over the long run. So we focus absolutely on identifying those types of businesses and holding those in the portfolio. The second is a recognition that there's actually few of these companies out there. So what we want to do is find them and ultimately manage an active portfolio. So I think Ryan at the very start talked about active versus passive. This is a very active approach. The active share of the portfolio is about 86%, which means that 86% of the portfolio is different from the index. And that is critical, we believe, to generating really attractive returns over the long run. And the third point is that we are sensible stewards of capital. So we believe in backing and challenging management teams of businesses in their journey to growing and adding value over the long term. We prefer to hold companies for periods of 5 years or more, which ultimately allows us to avoid excessive trading fees and costs that are associated with turning the portfolio over frequently. So challenging management teams and supporting them in their ambitions to grow businesses is really key for us. So what else differentiates our definition of growth, and how else do we think about it? Well, we define growth really in 4 different ways. We believe that companies grow and deliver earnings growth in different patterns. So we have stalwart growth stocks, rapid, cyclical, and latent. And what we're effectively saying here is that we are happy to embrace, and absolutely want to embrace, a broad pattern of earnings growth within the portfolio. So, for example, just to contrast stalwart growth on the left-hand side of the slide there, these, if you like, to make an analogy, these might be your best friend, someone who's there for you right through the tough times. So the analogous company example is a company that can move through different economic environments and continue to churn out steady levels of earnings growth, somewhere in the order of 8 to 10%. And what we would expect those businesses to have is an entrenched consumer base with a high degree of pricing power to allow them to do that. That can be contrasted to rapid growth businesses where it's very different. These are the friends that will take you on a night out, and in company terms, they're the ones that really grow their top line exponentially. So they're investing heavily and growing their revenues a lot initially to establish themselves in their competitive position, but we believe over the long run should be able to deliver really attractive levels of earnings and profit growth over time. We've used the example of Spotify there, who have democratized access to music via their online music streaming platform. I think the key point here is that whilst we embrace different types of growth, one thing is consistent among all the categories, and that is that we have a high bar for growth within the portfolio as a whole. So all the holdings, regardless of growth profiles, must at least be able to double, in our view, on a 5-year view. So that's the share price. We should be able to see that doubling over the next 5 years, and there should be around about a 30% probability at least that can happen. So how does the 100 stock portfolio look? Well, if you look at this slide on page 5, it shows you the portfolio and some of the recent trading. It splits the portfolio by growth profiles along the top and by holding size down the left-hand side. Now, I think there's 2 key things I want to get across here. That the first is that what we found over a long period of time is that the portfolio outperforms more often in aggregate than any one of the individual growth profiles. So fundamentally, we believe that taking this diversified and broad approach to growth has been beneficial for the trust over the long term. And the second point is that we seek to really harness the exceptional growth potential that's offered by equity markets. Just to explain that a little further, our view is that equity markets offer an asymmetry of return. So yes, you can lose 100% of your investment in an individual stock, but you can also make many, many times that initial investment. So we want to structure a portfolio that can embrace the probability and the possibility that you can make that multiple return on the investments that you make. So you'll see on slide 5 that there's a group of holdings around the 0.5% positions. So we have about 24% of the portfolio invested in these 0.5% positions. So we recognize that these are higher risk, higher reward. What we're really looking for is for these companies to do exceptionally well and graduate up to mid and large size positions. An example in the portfolio of something that's done that really well over the last number of years is Naspers, which is right at the top of the rapid growth column. That's a South African media and e-commerce business. It started life in the portfolio as an incubator and has graduated up to become our largest position. So moving on to an obvious question is why would we choose to invest in Monks now? Monks has performed really strongly for savers over the last 6 years. So since the Global Alpha team took charge back in March 2015, the return in share price terms for Monks is 219%. This is the end of January. And the net asset value for the trust is up 172%, and that compares to the FTSE World Index of 88%. What I would say is that on slide 6 is this tries to give you a better sense by way of some stock examples of the types of companies that we're looking at and we're investing in recently. So on the left, we have a number of names in what we call new frontiers, but essentially are companies that are utilizing leading edge technology of the internet to bring about profound changes in the way that companies do things. So for example, Datadog is a cloud computing business that's changing the way that enterprises manage their data and monitor their systems. We've mentioned uncorrelated opportunities there. That's really a nod to the fact that we have quite a diverse range of opportunities that aren't really correlated to anything in the portfolio. So, for example, Rio Tinto in mining, or Estee Lauder in cosmetics and makeup, very different avenues for growth in that part of the portfolio. And then finally, we have the eye of the storm, which is really a nod to the pandemic that Peter referred to, some of the opportunities that have come out of the pandemic for recovery plays. That's the case for some parts of the Monks portfolio, where we see businesses that on a near-term basis, the prospects might look quite bleak, but in a long-term view, we think it's likely to be a really attractive opportunity. So for example, in Ryanair's case, we think that they have actually strengthened their competitive position over the last 12 to 18 months, and that moving forward, that particular position is even more attractive than it was pre-COVID. Slide 7 builds on the point that I've been attempting to make in slide 6 around the trust, which is simply that there is a broad smattering of opportunities, and this shows the portfolio's underlying thematic exposures. So what we've done is group the individual holdings into areas that we think represent or accurately represent the underlying thematic exposures in the trust. So we've had long-standing positions in highly scalable platform businesses, which are companies quite simply that typically use the internet in order to provide their service. Now, within that, there's a huge divergence and differentiation of businesses. So, for example, we have Amazon, the e-commerce business, which is increasingly becoming infrastructure-like in the way that we carry about our daily lives. And that can be contrasted to something like Chegg in the US, which is an online US educational portal, or be contrasted to Meituan Dianping, which is doing food delivery in China. So a really diverse collection of companies that fall into that sort of sphere. We also have a meaningful position in emerging middle classes. So we see some parts of Asia, particularly China, growing in terms of the number of people that are moving into middle classes and increasing their levels of wealth. So there's positions in that part of the portfolio, specifically in areas like insurance. So we have positions in AIA and Ping An Insurance. Emerging positions include cloud enterprise or enterprise cloud, as you see in the top left there, that I've touched on with Datadog. There are a number of other positions there, and they're making profound changes to the way that companies utilize systems, moving away from on-premise software towards the cloud. And that has significant ramifications for how they pay for that and provide the services that they need. But an important and growing one is also transformational healthcare. We've been investing in a number of really innovative biotech businesses that are tackling some of the world's biggest challenges in the medical setting, and we think there's some really exciting developments there. So we took a position in middle of last year in Moderna, which I'm sure you've heard of, that the company has developed the COVID vaccine. The position on our part wasn't taken as a result of COVID. Instead, we think that the technology that they're applying in the treatment of COVID can be applied to a much broader set of diseases, which we think is hugely exciting. So you might then reasonably ask me, well, why should I invest in Monks generally? Well, I hope we've given you a quick overview there of what the trust is all about. But I think the key reasons that you should consider investing in Monks, firstly, there's an experienced team with an excellent track record of investing assets within the Monks Investment Trust. There's a clear focus for the trust, which is long-term capital growth. We're seeking to do that at a low cost for you as the saver, which we think is well aligned for those of you considering investments via your ISA. And then I think finally, the Monks Investment Trust gives you the very best access to the stock picking ideas of Baillie Gifford, of which we think there is a hopper full as we look forward from today's starting point. And that really underpins the confidence that we have in our ability to be able to add value over the long run from here. So that's me, and at that point, thank you all for watching, and pass back to Roland.